All right. Hello. Welcome, everybody. Just going to take a couple of seconds here to let everybody into the presentation today. Welcome to Smart Strategies for Women of All Ages, Investing for a Confident Retirement. I'm glad to have you all here today. My name is Amy Johnson, and I am one of the three advisors on the Stein Financial team. The other two advisors, a few of you on this call are probably familiar with Jeff Stein and Anthony Gerby. Anthony Gerby actually gives a webinar every single month. So if you've ever attended one of his, you know he does an excellent job and covers a lot of really great topics. And this webinar will be recorded today, and you can find that on our YouTube channel, Stein Financial Group on YouTube. And we will also be emailing out a copy of this presentation after it is over. Just so you know, there will be an open chat box today. So if you have any questions, feel free to put the question in there. And if I miss the question, our colleague Erin will be helping me monitor that chat. So if I miss something, she will alert me to it. We have a few disclosures here today. These are just definitions of um, the items that we are going to be covering today. And then we'll go ahead and get started with what our agenda is. So we're going to be covering what our retirement account basics are and what types of accounts are available for everybody and what your contribution limits are and things like that. And then we're going to cover the big question, Amy, how much do I need to save? And spoiler alert, the answer to that is it depends. Of course, it depends on what your age is, how long you're going to be in retirement, what your other income sources in retirement are going to be. But we will cover all of that so we can start to have a really good understanding of what we should be saving. Then we're going to cover our risk, and we are going to talk about the different risk tolerances that are available and why we might pick one over another. Then we're going to talk about funding our retirement. So, what are the buckets that we need to have, or buckets that will be available that we can pull from to create our retirement paycheck? Of course, it's always worth talking about common pitfalls. There's some certain things that are common mistakes that people make, and we're going to cover what those are and what we can do to avoid them. And then at the very end, we're going to have our action steps. We're going to have 5 action steps that you can take today, or by the end of this week. It won't take you more than a few minutes to do them. And I think it's valuable to say what's the one thing or 3 things I can do today to be better prepared. Then the other big question out there is, Amy, why women only? This presentation, it doesn't have anything in it that's only available to women or just for women. This stuff also applies to men. But I wanted to bring us ladies here together today. I know that oftentimes we're more comfortable asking questions when we're in a room of our own peers. And of course, there's a lot of things that affect women, oftentimes more than men. Sometimes we are often the primary parents. We're often the people who are taking time off work to care for our kids and our families. And we're also often primary caregivers for our aging parents. So there's a lot of things that we tend to take on a lot more than men. So I just wanted to create a space here for just the ladies. But when we're done here today, you feel free to share this with your husbands and other men in your life too. At the end, I think I've already mentioned this, we will have a live Q&A. But if you have any questions while we're going through all of this, feel free to just type it in the chat box. But at the end, we can actually unmute you if you wanted to ask a question. So we'll go ahead and get started with retirement accounts at a glance. I've put this nice little box together for us. On the left-hand side, we have employer-sponsored retirement accounts that are available. On the right-hand side, non-employer sponsored retirement accounts. And then at the top, these are all pre-tax retirement accounts, and on the bottom, they are post-tax retirement accounts. So we're going to start with the one that has the most. These are the pre-tax employer-sponsored retirement accounts. Not everybody has a retirement account available to them if you are employed, but if you do have one available to you, it would be one of these. Most common one is a 401k. We've all heard of that. That is for private sector employees, and it's a very common one that's offered. 403bs, those are for teachers, clergy members, other nonprofits. And then we have SEP IRAs and simple IRAs, and these are often implemented by employers of small businesses or for self-employed people. Keeping in mind, a SEP IRA is only an employer can make contributions to it. So if you have a SEP IRA, but you are not the business owner, you cannot make your contributions to it. There's also a 401k, a solo K that's available to self-employed people. So if you're on this call and you are self-employed and you're going, wait a minute, which one would I choose? Reach out. We can talk through the pros and cons of each one of them and help you pick the one that would work best for your business. 457 plans, those are deferred comp plans for public sector employees like county employees, state employees here in Minnesota. And I know that there's a few people on this call today that applies to as well. Then on the right-hand side, we have non-employer sponsored accounts. So anybody who works and has earned income can contribute to either a traditional IRA or a Roth IRA. A Roth IRA does have income limits, so if you are not eligible for that, you would be eligible for a traditional IRA. The one caveat there is if you are not employed, but you do have a spouse who is employed, you can have a spousal IRA or Roth IRA, and which one you pick would be determined by whatever your income is. So that is a really great option for us stay-at-home moms, moms who are taking, a little bit of time off to spend time with our kids, and we don't have any income that year. You can still use family income to save into a retirement account that is in your name. Just going to review contribution limits here a little bit. We're just going to focus on the top four lines here. So IRAs, Roth IRAs, contribution limit is 7,000. A catch-up is available for anybody who is 50 or older, so that would make $8,000 total. Keep in mind these amounts do change. In 2023, it was 6,500. So every few years, we're seeing it go up about $500. A simple IRA, you can see actually did go up this year from 16,000 to 16,500. There's also a catch-up limit for people who are 50 and older for simple IRAs. SEP IRAs are a little bit different. SEP IRAs, the maximum contribution is 25% of your net income, so after-tax income. So let's say your after-tax income is 100,000, you can contribute up to 25,000 into that account. It is capped at 68,000. And a 401k, your 403bs, you can see those limits are quite a bit higher than, a traditional IRA. It went up this year. It's at 23,500 with a pretty significant catch-up limit of 7,500. Something to keep in mind that these amounts are both your contributions and your employer contributions would equal these amounts. So something to keep in mind if you're getting that employer match. Now, these are contribution limits for HSAs, and we actually haven't talked about HSAs yet because HSAs aren't technically a retirement account, are they? They are often billed as, our health savings accounts where we can use pre-tax dollars to pay for our medical bills When we withdraw, it's all tax-free. The nice thing about HSAs, though, is that you don't have to use them for your medical expenses if you don't want to. You can pay your medical expenses out of your bank account, and you can continue to let your HSA grow. The one caveat is you do need to have a high deductible health plan. You can see in the blue line in the middle, you need to have annual um, deductions of 1650 for single people, 3300 for families. So it actually applies to a lot of people, even people who have employer sponsored coverage. A lot of people these days are in high deductible plans. Something that's great about health savings plans that if you or health savings accounts that if you aren't spending down that cash every year, once you've hit a certain balance, and each one is a little bit different, you can actually invest those contributions. So it's actually a triple tax advantaged account. And I know there's a lot of people out there that don't know about this, but you're using pre-tax dollars, it grows tax-free, and then when you pull those withdrawals out, they are also tax-free if you use it for a qualified medical expense. So the question is, well, Amy, what's a qualified medical expense? We know a lot of basic things are qualified medical expenses, but there's actually an exhaustive list provided by the IRS that gives you a full breakdown of what is a qualified medical expense and what is not a qualified medical expense. And something to note that applies to a lot of women is starting in 2019, over-the-counter medicine as well as menstrual care products, period products, are now considered medical care and they are considered a covered expense. So you can actually use pre-tax dollars that are in your HSA to help cover those products if you need. So that was a great win for women in 2019. Also, if you continue to let this grow or have any amount into your HSA at age 65, you can actually withdraw everything with no taxes, penalty free. You do have to wait till you're 65 years old. And at that point, you do not need to make withdrawals for qualified medical expenses. And so that's what I love about the HSA is triple tax advantage. Once you're 65, you can use the funds for anything. And I think that that's something that a lot of people aren't aware of out there. So I always like to highlight the advantages of HSAs. Erin actually has a copy of that document from the IRS, and she is going to go ahead and post that into the chat. You can download it, or you can also just Google it if you would like to, but it is available in the chat for everybody right now. So then the question, Amy, well, do I put it into traditional? Do I put it into Roth? Which one is the right one for me? It all comes down to what your current tax rate is going to be versus your future tax rate, right? So anything traditional, a 403(b), your 457, you are getting that tax break now. And then when you withdraw it, when you are retired, you will be paying your ordinary income tax rate, whatever your tax bracket is at that time, on your withdrawals. A Roth account, whether it's a Roth IRA or a Roth 401k, is you're using after-tax dollars, which means once you invest it, everything grows tax-free. So when you decide to make withdrawals in retirement, you are not paying taxes on that money. So what does it matter which one I'm putting it into? I'm going to pay taxes, Amy, eventually, right? I'm either going to pay taxes today or I'm going to pay taxes later. Well, we can use strategies for investing to help optimize our tax efficiency. And I'm going to talk a little bit about the tax triangle now. I'm a visual learner, so I like this tax triangle here. I like to make sure that people kind of understand that there is an advantage to having assets. It don't need to be equally divided between the three triangles, but it's nice to have assets in each of the buckets for a variety of reasons. And I'll give an example at the end. So at the top of the pyramid in the green part, We have our tax advantaged accounts, right? So these are going to grow tax free. You have tax free withdrawals as long as you are at the age where you can get those tax free withdrawals. Again, Roth IRA, Roth 401k, your health savings account. Remember, that's actually triple tax advantage and municipal bonds, which we haven't talked about yet. Now, municipal bonds are generally speaking going to be in a taxable account. They're going to be in an account that's in the bottom left, that light blue part of the triangle. They will often be in taxable accounts, but if you have a municipal bond in that taxable account, they are federally tax-free. And in the state of Minnesota, if you have a Minnesota municipal bond, it will also be tax-free in the state of Minnesota. So it belongs in the green part of the triangle, but that actual fund would be in the taxable part, in one of those accounts anyways. And then your permanent life insurance cash value. We're not going to get into that today, but that also belongs here. Then you have the tax deferred part of the triangle, the dark blue. This is going to be most people's largest chunk. The largest amount of dollars are going to be in here because these are your traditional savings for retirement. Traditional IRAs, 401ks, 457s, 403bs, things like that, are going to be in there. Um, and so annuities are also in there, and something to keep in mind about annuities is they are actually always tax deferred. So it doesn't matter if they are in a what we call a non-qualified brokerage account or if they're in your retirement account, they're always going to be tax deferred. And then whenever you withdraw it, regardless of what kind of an account it's going to be in, they're always going to be taxed at your income rate. And they are pulling out dollars, LIFO, the last in, first out. So all the last dollars in, which would be all of your growth, is going to be what would come out first, tax at your ordinary income tax rate. And as you get to the end of withdrawing on that annuity, it's actually going to be your principal you're withdrawing, and then that is actually tax free. And then moving on to the final part of the tax triangle, taxable accounts. So your um, savings accounts, money markets accounts, those are going to be taxed at your ordinary income tax rate. And then you have non-qualified brokerage accounts. And kind of depending on what's going on in there, depends on how that is taxed. Um, you are paying taxes each year on non-qualified brokerage accounts. And they are typically speaking taxed at the capital gains tax rate. Long-term capital gains, so anything that you've had invested for over a year and then you sell, is going to be taxed at 15%. And also any qualified dividends that were paid out into that account are also going to be taxed at the capital gains tax rate. Now, if you sell something that you've held less than a year, that's would be a short-term gain. You are going to be paying your ordinary income tax rate on that. So something to keep in mind that it's worth keeping investments in those types of accounts for at least a year because most people are under the 15% capital gains tax rate. So again, this is about optimizing tax efficiency, making sure that we have a good balance in all these accounts. Most people are going to be filling their buckets that are in the tax advantage and tax deferred taxable assets will start to come for a lot of people later in life once they maybe max out their 401ks for the year and they have a little bit extra to invest. A lot of times people who receive inheritances those dollars will go into a taxable account. So if you're younger and on this call, don't worry too much if you don't have anything in that part of the triangle. That's something that you would fill out more as you get towards retirement. Now, why does having the assets in all these different parts of the triangle matter? Well, it helps increase your flexibility. So I'll give you an example. Let's say you are retired, you're not receiving a pension, and you are withdrawing $50,000 a year from your retirement account. You're getting Social Security to supplement that. You're taking a monthly distribution from your IRA, and that totals 50,000. That puts you in tax bracket A. Now let's say you need to withdraw another 50,000 this year. Maybe you need a down payment for a cabin, something like that. Well, if we were to withdraw that other 50,000 from the same IRA you've been taking money from, it could quite possibly bump you into another tax bracket. It could also bump you into another Medicare tax bracket. So once you're 65 and you're on Medicare, what you pay for Medicare is dependent on your income. And if you get bumped into another Medicare tax bracket, you will end up paying more for those costs. So it's a great opportunity to then take from your Roth IRA. Your Roth IRA is tax free, it doesn't affect your income tax rate. And so it's really great to have some of those options for when life's unexpected events happen. So moving on to your retirement savings goal. Remember when I said, Amy, the big question is, how much do I need to save in order to retire? And the answer is, well, it depends. So we'll go over a few things here. I'm going to start actually with the second bullet point, which is start where you are. Progress is always what matters. If you can't do the 15%, that's in the first bullet point up there at the top, that's okay. Start where you are. Progress is what matters. There's going to be points in time in your life where you're able to save more. Sometimes you're able to save less, and hopefully all ends up evening out. I'm going to show you this graph here. I love this graph. It's a good visual. Year zero can be at any age. So whatever age you want to start saving, that's year zero. Let's say year zero is 40. I'm right about 40 years old, so let's say year zero is 40. If I, between age 40 and 50, for 10 years, made contributions of $8,000 and I was getting a 6% return on those $8,000. Now that's the 8,000, or excuse me, 6% for the whole time it's invested, the first 10 years, as well as all the additional 20 years after that. 6% rate of return, but I only put in for the first 10 years. That is a total of $80,000. So you can see at year 10, when I'm 50, it's a little over 100,000, maybe 115,000. No, I'm not putting anything else in for the next 20 years. So when I am 70, that will be worth a little over 350,000. And I love showing people this visual because it just shows how important starting early is, getting things invested, even if it's a smaller amount. It's a great graph to show younger people as well. So if you have anybody in your life who is younger, kids, grandkids, and they maybe graduated college recently and they're spending their money and they're not really saving anything, I encourage you to show this to them and talking to them about the importance of all this compounding interest. So then back to the top to the third bullet point, where should our savings priorities be? Number one, our emergency fund. We always need to make sure that we're able to cover unexpected expenses, job layoffs, things like that. So I like to call my emergency fund my sleep number. It's the number that allows me to sleep at night comfortably. For some people, that's 10,000. For some people, that's 50,000. Another way to look at it is 3 to 6 months of your expenses. I'm sure we've all heard that in case we go through a job layoff, things like that. Always fund your emergency fund first. Once you have that established, do whatever you need to do to get your match. If you are lucky enough to have an employer-sponsored plan and you're lucky enough to get a match, do what you can to get that. It's free money. It's a part of your compensation package. We don't want to leave that money on the table. So if your company says we'll do 100% up to 5%, that means if you put in 5%, they'll put in 5%. They say we'll do 50% up to 3%. That means that in order to get 3% from them, you need to put in 6%. Do whatever you need to do to make sure you're getting that match. Once you've reached that, I often encourage people to put their next investment piece into a Roth IRA, and that is if you qualify for a Roth IRA. Again, there are income limits around Roth IRAs that are going up every single year. But if you do qualify for a Roth IRA, I would suggest putting your next investments in that. And I say that over a Roth 401k for two reasons. First reason is with a Roth IRA, you're going to have access to hundreds of different options for investments, mutual funds, ETFs, individual stocks. Um, you know that most 401k plans, and this applies to 403bs and 457s as well, you only have so many options. They give you a list of 20. That's what you have to pick from. You don't get to make any other choices. So if you are going to invest money, why not put it in a Roth IRA versus a Roth 401k? Then you have a lot more investment options. Second reason is with Roth IRAs, you are able at any point in time to withdraw your principal, any of your contributions out of that account, tax-free and penalty-free. So let's say something major comes up, your emergency fund's been drained, you need a little extra, you can tap into the contributions that you've put into your Roth IRA. You don't get that with a Roth 401k. So just something to keep in mind about, where should I be saving all of my money and why? So asset allocation by risk level. I like to say there are five. This graph here shows three, but the other ones are just moderate conservative and moderate aggressive, just kind of in between these three here. For our conservative investors, oftentimes these are older retired people who just need to have capital preservation in their account. They're not too concerned about it growing. They do not want to take the risk. They want to make sure that that money is there, but they don't need any growth for whatever reason. For those that are on the call today that have access to pensions, a lot of times I see that our clients are in this conservative risk tolerance level. You're getting plenty of cash flow through your pension and your Social Security, and you don't need your deferred comp plan or your IRA to grow significantly. You definitely don't want to lose any money, so you stay conservative. For a lot of people who are in the accumulation phase, whether well, if you're still working, or even if you are retired and you don't have access to a pension and you need your retirement accounts to fund your actual retirement, you will have to take on a little bit more risk in order for that account to grow to get to that level that you need. So it's there at your desired retirement age. If you take less risk and it doesn't grow at the rate it needs to grow at, you may end up having to either A, work longer or B, take less money in your retirement. For people in the accumulation phase or even shortly into their, first 10 years of retirement, we do need to see growth in order to fund our retirement with those retirement accounts. Aggressive, this is great for younger people who are in their 20s and 30s and have decades before they need access to these dollars. Even if we have sustained down markets like in the 2008 Great Recession, there is still plenty of time for younger people for their accounts to recover. And so that's where we usually see people who have aggressive risk tolerances. So here we have understanding investment types and portfolio composition. Just kind of want to run through this briefly. What's the difference between a mutual fund and an ETF? They're both pooled investments, but a mutual fund is actively managed and professionally managed. Mutual funds can have individual stocks in them, other mutual funds, ETFs. And there is an active manager. You can Google who they are and you can read about their experience and how long they've been managing this mutual fund. And they do end up costing a little bit more because of that active management. ETFs, they trade kind of a little bit more like a stock and they end up tracking indexes. They are often comprised of a lot of stocks, but they can also hold other types of funds within them. And because they're not actually actively managed every day, they do tend to have lower fees. Um, Now, I just want to give an example of a sample portfolio because people will say, hey, I'm moderate, but how does my portfolio look in terms of balancing out what that means? So we do have 40% in bonds, and I apologize, I didn't get this on the slide here, but that would comprise of corporate bonds, treasury bonds, uh, and then high yield bonds, which are a little bit more risky. There's short duration, long duration bonds, so a variety of different bonds. And then on the stock side, we want to make sure that we have um, large cap, mid cap, and small cap companies. Your large cap growth companies are going to be things like Amazon, Meta. You want to balance that with good large cap value companies. Value companies is their purpose is an exponential amount of growth. They are well established, stable companies. They tend to pay higher dividends, and they just have slower growth expectations. Think Coca-Cola. Mid-cap companies, again, we want to have a balance of growth and value. Companies you might be familiar with here in Minnesota are Ecolab, Polaris. And then we also have international stocks, which will also be comprised of developed markets like the UK, Europe in general, Japan, and then there's also emerging markets, international stocks, and those are emerging economies, economies that have a little bit more volatility due to political reasons or just their currency is a little unstable. And so you want to have a good balance of those in your international stocks portion of your full portfolio. Retirement income sources. So the first bucket is going to be a big one for most people, your retirement accounts. We've gone over all those. Then there is your Social Security, and I know that some people are concerned about Social Security. And if you've joined any of our webinars before, you've heard Anthony talk about this in depth. Um, Social Security is going to be there for the vast majority of us when we get to retirement age. A few things that might change in order for them to make the adjustments they need to would be maybe changing the full retirement age, changing how Social Security is taxed. But I think for everybody on this phone call, that's not going to really impact us. This is going to be applied to much younger people. Any of those changes that are gonna come through. They say, it's Social Security is going to become insolvent in 2035. I think that's what they're saying now. But what that just means is they're now taking in less money than they're paying out. So there's still plenty of money there. They're just not replacing everything that they're paying out every year. So something will have to give. Um, and there's a variety of ways to do that, but just know that Social Security should be available to us. And then you have your health savings account, which I've talked about at length, and any part-time work that you might have in your retirement. One bucket I forgot to put on here, and I apologize to all of our public employees on this call, would be your para, your pension, and anybody else who's lucky enough to have a pension. Obviously, you wouldn't have as much in your retirement accounts as anybody else, but that would be a fifth bucket if you have access to it. So here we have withdrawal strategy basics, and these are concepts that are like it says, they're basic. They aren't hard and fast rules, but if you're not working with a financial professional, these are kind of some things to keep in mind. We have the classic 4% rule. This is obviously a guideline, but um, it it it's a guideline for a reason that a lot of people do follow this 4% rule. So think about how much you have saved right now. Think of whatever 4% of that is. Let's say you have $1 million saved. You're looking at retirement in 5 years. 4% of that is 40,000. Is that enough? Coupled with your Social Security and any other income sources you might have if you're married and what their income could be, is 4% enough? And if it's not, then let's talk about how we can, um, dig in our heels and get to that 4% by the time you retire. And then we have coordinating your withdrawals with Social Security timing. So there are strategies around when we want to claim our Social Security. For some people, they would benefit from claiming it right away when they retire, whether that's 62, 65, full retirement age of 67, or delaying it until they're 70. There is an 8% increase after your full retirement age to age 70 that you get if you delay it. And then you want to coordinate that from when you take your para when you retire or start withdrawing on your investment account. So there's strategy behind all that. And if you work with anybody on our team, we're going to run all those numbers for you, and we're going to give you, the best options for you as to when you should start doing what. The third point, we haven't really talked about required minimum distributions, but these are going to apply to everybody if you have a retirement account. It's currently age 73 if you were born between 1951 and 1955. Otherwise, everybody else who's a little younger, at 75, we're going to have to start withdrawing on our retirement accounts. And there is strategy about reducing the amount that you need to pay on your retirement accounts for or not pay, excuse me, but withdraw from your retirement accounts for your RMD. You can do things like uh, um, Roth conversions, which is when you're in a lower income tax bracket. Maybe there's a year that you are taking time off work to be with your young kids, or you got laid off for 6 months of the year, and there is a period of time in your life where your income is just a little bit less than it would normally be. That's a really great time to do a Roth conversion because again, you're going to be paying your taxes on any withdrawals from your IRA, but the key is to do that when you are in a lower income tax bracket. So you can actually at any time convert anything from an IRA into a Roth IRA and pay taxes on it today. You can also do qualified charitable distributions. So if you are already giving to some of your favorite charities, once you are 71, you can take those donations straight out of your IRA and have a check sent straight to the organization on your behalf, and then that is tax free. So there's strategies about reducing what you are required to take out. And then the tax smart withdrawal sequencing. We've kind of talked about that as well already. When you want to withdraw certain funds and which part of the triangle we're going to withdraw that from. So then we have the common pitfalls. So there's a few listed here. There's a few other ones I want to talk about, but the first one is kind of the biggest one for me, missing out on that employer match. You've heard me talk about this a few times already, but do what you need to do to get that match. Don't leave it on the table. Not reviewing your investment choices. This is also a big one. A lot of people just invest it. Somebody at their work says put it in this, and then you don't really ever think about it again. And when it comes time to, looking at that pie chart I'd shown of are we well balanced between international stocks and domestic stocks and large cap stocks, and you go, I actually don't know where my money is. Um, if you're not reviewing those investment choices, what was really good for you when you started investing at 30 years old isn't necessarily what's good for you at 60 years old. So, taking the time to review those on a regular basis and at least having an understanding of where you're at. Sitting on too much cash. This only applies to certain people. Obviously, if we're in our accumulation phase for our retirement, we generally don't have a ton of cash kind of sitting around. But believe it or not, it does kind of happen where people have, a few different accounts. They have this CD over here. They have a high yield savings. Then they have their everyday regular checking and savings. And when they add it all up, they're going, oh wow, I have 100,000 in cash and I didn't even realize it. And then you're missing out on an opportunity to get that cash invested. Now, how much is too much cash? Whatever is beyond what your sleep number is. Remember, we talked about, what is your emergency savings? What's your sleep number? If you're starting to accumulate cash well over that, especially if you're older and you are getting income from para, you are getting income from Social Security, you're now taking your RMDs, and all of a sudden you just have way too much cash. Talk with a financial professional about what the options are. There's a lot of options, and even right now, even just getting it into a high yield savings account is better than just your regular old savings account. The fourth common pitfall is not increasing your contributions with income. So we've all heard the term lifestyle creep. And that happens when we get raises, we get bonuses, and we're just excited to spend it and have nicer things, buy more things. So, what I like to suggest to people is get to your comfort level. Get to the lifestyle that you're really comfortable in. And anytime you get a raise or a bonus over that, put it into savings, put it into your retirement accounts. We see it all too often that all of a sudden we went from being, Honda to people to now we have a BMW lease payment, every 3 years, and we see that lifestyle creep happen a lot. So let's do what we can to make a commitment to finding our current lifestyle that we're really happy with, and then anything that's above and beyond that, let's start putting towards savings. Underestimating healthcare costs. Now, this isn't going to apply to everybody on this call today, but there does get a point in your life, obviously, once you're a little older, where healthcare costs start to get to be a little bit more expensive. And once you're 65, you do qualify for Medicare. And we actually have a Medicare webinar coming up. Anthony Gerby is going to be hosting that, and along with a partner that we work with who is a Medicare expert. That's what he does every day, is help people figure out what their Medicare plans should be, what's best for them based on the needs that they have. But he also helps people find insurance in any sort of a gap year. So if you retire at 60, but you're not eligible for Medicare until 65, he will help you find a plan that gets you until you do qualify for Medicare. So that's actually going to be hosted on the last day of this month, I believe, September 30th. And Erin looks like she already just posted that link for that Medicare webinar. So if you're at the age where Medicare is important to you and you're coming up on it, or you need to renew this year and you know there's going to be some changes in Medicare, which there are this year, please sign up for that webinar. We'd love to see you there. Um, and a couple others, or at least one other that isn't on here, that I should add to next time I do this is consolidating your small accounts. A lot of people, especially if they job hop when they're younger, they have these small accounts kind of everywhere. I have this 401k from this old employer, and I have another 401k, and I don't really know, where they're at exactly. And it will just save you a lot of headaches in the future if you just start consolidating them. If your current retirement plan allows you to consolidate into that, which a lot do, you can certainly do that. So just transferring from an old 401k to a new 401k, or you can consolidate them into an IRA as well. And if you have any questions on that, we can help you figure out what the best option for you is. But I promise you that if you had a job when you were 30 and you have this little 401k, you might not remember exactly how to access it when you're 45. So we always encourage people to just start consolidating right away when we leave jobs. Alrighty. Well, now we have what are your next 5 moves? I want to make sure that I leave everybody here today with what can I do today, Amy? First thing is log into your retirement accounts. If you have multiple, spend the 15 minutes. I know it's going to be a little bit of a headache, but Take 15 minutes, make sure you can log into all of your accounts. If you have to reset the passwords, do that, put them in a safe place. But if you know exactly how to get into your retirement accounts, then you can, look and see how they're set up and what options that you're allowed to do within your website. Different plans allow you to do different things without having to do extra forms. So log into your retirement accounts, save your password someplace safe. That's step one. Everybody on this call today can do that. Know what your contribution percentage is. I am a firm believer that we should be able to rattle off what we're contributing to our retirement, just like we are able to rattle off what our mortgage is, right? My mortgage is 1,800 and I have a 5% interest rate. I have a $350 car payment that's going to be paid off next year. I am saving 10% into my retirement account. I'm maxing out my HSA every single year. I'm a firm believer that we should know those numbers off the top of our head. Then the next thing is, well, can we increase that contribution? Can we bump it up 1%? I have found and just recently gave this presentation. It was an in-person presentation. We held it at our office building at 1600 Utica, and one of the women in that group was like, "Amy, I think I can do that." Like 1% isn't that much. That's not really going to affect my monthly budget. I almost don't think I'm going to even notice it. And so she did, and she let me know that she did it, and I was so happy for her. 1% doesn't seem like a lot, but 1% compounded over time, it really is a lot. And then review your investment choices. So if you're one of those people who doesn't know where all your money is, or you have your main account and you feel like it's well balanced, but you have some of these other older accounts out there, your risk tolerance might not be where you want it to be. You might not be as balanced as you think it is. So if you're unsure how you're invested, um, let me know, and I'm happy to run the reports for you. We have Morningstar. We can run reports through them, and we can figure out where your breakdown is. So I'm gonna go back to this screen here. Maybe you know what mutual funds you're invested in, but you don't know how much of your portfolio is in stocks versus bonds and what kinds of stocks. And you're like, I don't know if I'm in the right mix. I see this mutual fund is large cap, or this mutual fund is international, or this is a total return bond, but Amy, I don't really know what that means. Let me know. We'll go ahead and run those reports for you, and we can talk about if you're in the right investments. And then the fifth thing that you can do today is you can schedule a financial check-in with me. I would love to have a conversation with everybody on this webinar today. Would be happy to go over all of these items. Would be happy to talk to you about anything else we didn't cover today. We do complimentary consultations with anybody. If you have somebody in your life that you think could benefit from a conversation, whether that's a friend, a child, a grandchild. We love working with younger people. We want to make sure that younger people are getting started on that financial journey at a young age. If you're on this call and you are currently retired, you understand how important it is to start young, and maybe you even have some regrets about maybe not starting sooner. So encourage the young people in your life as well to schedule a time with me. Erin looks like she just posted a link directly to our booking page where you can go ahead and just book a consultation meeting with me. Um, and I think that kind of wraps everything up today. Here is my contact information if you wanted to reach out to me personally. That's our office number, my email address, and we have a really great website at steinfinancialgroup.com. You can learn about all of our other events on there. We post a newsletter. We have some really great resources, so feel free to check that out. I'll go ahead and let everybody go. Thank you so much for all of your time today. I really appreciate you all being here, and have a wonderful rest of your day.